Hello everyone, I'm Caleb. In this video, I'm going to help you understand what dividend investing is and what it is not. I'm also going to explain how our dividend family uses it to help create income. So before I get started, smash the like button below. The Dividend Depot was started to elevate the way our dividend family thought about their finances. A portion of that conversation always includes discussions about investing, and our parents have always promoted a healthy curiosity for the stock market. Now I'm going to explain what dividend investing is and what it is not. The definition of dividend investing is an investment approach of purchasing stocks, which is investing in companies that issue dividends. This allows our dividend family an effort to generate steady, passive income. Fun fact: the Dutch East Indian Company was the first recorded public company ever to pay regular dividends. It paid annual dividends near 18% of the value of its shares between 1602 AD and 1800 AD. That's a little over 200 years of paying a dividend. Our dividend family has been dividend investing since the Great Depression. So we still have a few ways to go to match that 200-year number. Dividend investing starts by investing in a company that sends you a portion of their profits, or dividends. Many companies distribute cash dividends to you, their shareholder, at different times during the year. Most issue a dividend on a quarterly basis or every 3 months. That means you get sent a check, like our older members, or an automatic deposit in your account, like our younger members, 4 times a year. There's also some companies that issue dividend payments at other times. Some companies will send you payments twice a year, or some will send them 12 times a year. There are also some companies that don't pay a regular dividend, but sometimes the companies that don't pay a regular dividend will pay a special dividend to its shareholders. Another good thing about dividend paying companies is that they are not easily affected by a slow economy. On February 22nd, 2021, MarketWatch published an article that stated the U.S. dividend payouts hit a record high during the pandemic. Imagine that. Even though the U.S. economy slowed down drastically, U.S. companies continued to pay dividends. You want to know why? Many companies hate to cut or stop their dividends because investors hate companies that cut or stop their dividends. Companies that have consistently paid a dividend even have their own title. They're called dividend aristocrats. In order to be a dividend aristocrat, a company must have increased its dividends for 25 consecutive years. Being a dividend investor also gives me less reason to worry. The company's dividend gives it a bit of a cushion as the company's stock price begins to fall. Unless the stock price is dropping for a horrible reason, investors are more likely to step in and buy more of the stock to get a larger dividend check. Remember, you have to be a shareholder to get these regular dividend checks. And in order to be considered a shareholder, you must own the stock on the dividend record date. The record date is the date that the company reviews its list to determine who owns their stock. If you do not own the stock on the record date, you are not entitled to receive a dividend check. Likewise, investors who buy the stock on or after the ex-dividend date do not receive a check on the upcoming payment date. Okay, now it's time for me to tell you what dividend investing is not. Number 1, dividend investing is not exciting, at least not in the way you might be thinking. Naturally, there are investors that like to say they own a piece of the latest and greatest companies making headlines. However, the highly talked about stocks come with a lot of ups and downs. We like the stocks that no one talks about, but slowly keeps chugging along, making money, and possibly increasing the size of the dividend check it sends. We like the excitement of knowing that money will be in our accounts on payment day. Number 2, dividend investing is not just for old people. Dividends are really liked by older people. They want dividends to help preserve capital and or to create an income. However, as young investors, my sister and I enjoy seeing the money that comes in almost like an allowance. A lot of times we reinvest our money to increase our shares of the company. And finally, number 3, Dividend investing is not safe. Investing is risky, no matter what you invest in. Comic books rip, cars crash, and clothing styles change. So when investing, never put all your eggs in one basket. That's it for this video. So remember, we like dividend investing because it creates a steady cash flow. The last thing is to always talk to professionals about your specific investing and tax strategies. Don't forget to smash that like button. And to our dividend family, good morning, good afternoon, good evening, and good night.